Okay, so we're trying something a little bit different today, clearly, and new. This is the first live I've done, so please bear with me. So I'm joined by our Chief Investment Officer, Iain Ramsay, and we're going to be talking stock markets, what's happening at the minute, is the world going to end, and should you invest or hold on to your cash? So Iain, I'll let you introduce yourself first of all.
Okay, yeah, thanks for having me today, Joe. As you mentioned, I'm the Chief Investment Officer here at AHR, so responsible for overseeing and implementing our investment strategy, which, as you mentioned, is quite a difficult task at the moment.
Okay, cool. So I'll jump straight into it then. So obviously what's on everyone's mind at the minute, so why has the market dropped this last 6 months and what's happening?
Yeah, so, as you said, markets have sold off heavily over the last 6 months. And really what it comes down to is a couple of things. Inflation being one, and then the consequences of that, higher interest rates. So as we've all seen, the price of everything pretty much has gone up. And then subsequently, because of that, central banks around the world have raised interest rates, meaning that the cost of borrowing, everyone's mortgages, any loans, all those have gone up. So that's really been a driver of markets decline over the last 6 months. And there's a couple of factors to that as well, Joe. One being the valuation element of it. So really, if we look at, if I can get an interest rate, a higher interest rate in the bank, then the risk of investing in the equity markets, I'm going to pay less for that. So that's why we've seen a sell-off from that perspective, from a valuation perspective. And then secondary to that, rising interest rates then brings around a concern around, economic growth moving forward. If people are spending more on their mortgage and they're borrowing, are they going to spend as much? If businesses have to pay more to borrow money, are they going to invest as much? And therefore, is growth going to slow down? That unsettles investors. And that's, again, part of why we've seen this huge sell-off so far.
Okay, so how bad is it going to get?
Well, I mean, of course, we never know entirely when we're in the worst of it. But, I think there's a lot of indications from an investment perspective to say that right now we're in the midst of the worst of it. And I say that because, you look at different studies, research, you look at history. This type of market decline would suggest we're very much in the realms of the worst of the scenarios that could be faced with. From an economic perspective, unfortunately, the worst could yet still be to come because, rising interest rates, the effects of that are felt further down the line.
Okay, so when then? So how long is it going to take for things to start getting better or picking up?
So again, and that's the question everyone will be listening to, thinking, okay, right, this is what we want to know. But really, we need a couple of things to happen before things can start to get better. What we need to see initially is a cooling off in inflation. So again, that's really been the driver of the market sell-off. What we need to see is that actually inflation is not going to keep getting higher and higher. We need to see that actually it starts to subdued, and then it can just plateau, and then people can take conviction in that, and then they're not going to be continuing paying higher prices. It gives everyone in the economy more confidence. And then secondly, then what we need to see from that, we need to see central banks committing to a path forward of rising interest rates. Again, investors don't like shocks. They don't want to see that one week the central banks are saying they're going to raise interest rates by 0.5%, then they change their mind to 0.75. That sort of uncertainty unsettles everyone. So we need a cooling off in inflation, and we need moderation and a clear path of interest rate hikes moving forward. Again, I appreciate that's not the sort of the golden ticket answer, but that's exactly what we need to see before we can start to think about brighter days ahead.
So how high do you think interest rates are going to get?
Interest rates, I mean, personally, I think the interest rates have been too aggressive so far, because if you look at the elements of inflation, what's causing inflation right now, a big chunk of it is energy costs and food. The Russia-Ukraine crisis causing a lot of those supply shortages in food in areas that we all use in our day-to-day food staples. So I think that trying to control that with interest rates is not a winning recipe. So I think, the US tend to take the lead. They raised interest rates by 75 basis points at the last meeting. The next meeting, it looks like they might also, which would take us to about 2.5%. We may get towards 3% by the end of the year in the US. I think the UK might be a bit behind that. Obviously, there's slowing down in economic growth in the UK already, so much harder for them to continue to raise rates.
Okay. And what's the risk of rates increasing too fast?
I mean, the risk is really that there's always a lag to putting interest rates in place now. The effects of that will only be seen maybe in 6 to 12 months. So the risk is they raise interest rates high now, inflation cools off, maybe we get moderation in, or maybe there's a resolution to the Russia-Ukraine conflict, maybe energy prices subside, they've raised interest rates, and then we all feel the effect of that in 6 to 12 months' time, when it's perhaps not needed. And that's the risk, is that you're actually playing with economic growth. You're playing with consumer spending. You're playing with business investment. So the risk is that they raise rates too aggressively, and subsequently it's maybe not needed. That's really the biggest risk we see right now.
Right. Okay. And again, obviously, we spoke about inflation quite a lot, but why is inflation so bad for investors? Or why is high inflation so bad for investors?
Yeah, of course. Yeah. So really, and in theory, again, inflation shouldn't be a bad thing. Inflation should be an indication that we've got a healthy economy. What traditionally it means is that we're all spending more money, we're demanding more, and therefore the price of things is going up. The problem is, and the reason why it's been bad in this scenario, is that it's not led by demand, it's actually led by supply. So, we talked about Russia-Ukraine forcing the price of energy up, forcing the price of food up. And then we've had supply chain issues coming out of COVID, bottlenecks in many ports around the world, causing supply chain issues, which have caused inflation to rise up. Therefore, it's not a healthy demand-led inflation. It's these supply shocks that are causing inflation. Why is that bad for investors? Well, again, it comes back to what happens when we get this level of inflation. Central banks then raise interest rates. That, as we know, is bad for the reasons we mentioned. From a valuation perspective, equities then get repriced lower. And then from a forward-looking economic growth perspective, we get nervousness, we get investors being unsettled, and therefore, again, equity prices kind of come back down to reflect those concerns.
Okay, so so we're hearing a lot at the minute in the news and the media about a recession. So recessions come in, depending which website you look at, it is or it isn't. I mean, what is a recession? What does it mean? And what happens then? I mean, technically,
a recession is 2 consecutive quarters, so 3 months of negative gross domestic product, so economic growth effectively. So you have negative, so the economy is actually in contraction. That's technically what it is. Again, it's very difficult to say whether we are entering or even in the midst of a recession. A lot of people, I've heard a lot of commentary recently saying perhaps we're already in a recession. If we think about it as investors, what does that mean for us? Well, we look again throughout history, markets tend to sort of front run any economic data. So if we are headed towards a recession, a lot of what we've seen in terms of equity markets so far this year, perhaps have already priced that in. Okay. Again, so we might see the data come out towards the back end of the year. And again, I don't really want to say we're definitely headed for a recession. There's lots of positive economic data still to suggest we might not be. But if we are, I think the investment markets have perhaps already discounted some of that possibility.
Okay, so I suppose what everyone's thinking now then, so do I invest or do I wait?
Yeah, okay. I mean, I am, of course, an advocate for equity markets. And I would always say now is the best time to invest. And I don't say that lightly. Some people may watch this and say, well, how can you say that with such high conviction, with so much uncertainty going on in the world? You know, and as I know you often talk about, Joe, the most important thing with any investment approach is having your objectives, having your plan, being consistent and disciplined with it.
Yeah.
So as long as you have that at the outset, I would say that, coupled with the fact that we have seen significant market sell-offs, now is a good time to be investing and putting some of your money to work. And again, you know, are we at the bottom of the market? No one has the answer to that, unfortunately. However, if you look again historically, when the market's sold off over 20%, always been a good time to invest? I think it's fair to say it has been. So again, coupled with your planning around that, I think, yeah, now's a good time to be looking to get some money to work.
All right, okay. So when investing, how can you reduce, so when you're actually investing, how can you reduce your risk? How can you keep your risk as low as possible?
Yeah, so I think firstly, it comes down to having that plan at the outset. You know, what you're looking to achieve, what's your objectives with your investment, and how much are you willing for that to fluctuate along the way, and really testing your own thoughts about that. If my money goes from here to here, am I okay with that? And that then determines how much risk you're willing to take along the way. How you can mitigate risk is about having the right approach, the right strategy in place, and having the right levels of diversification. That's the most important thing. You know, so then we know, okay, I've got hard limits about how much I can invest in a certain region, in a certain type of investment. I might want to have 60% invested in equities and then 40% remaining in more secure areas of investment. So having that level of diversification can help you manage risk and make sure you don't get any nasty surprises that are linked to any one particular country. I think where people have perhaps gone foul, gone wrong, and certainly maybe since COVID, is buying into some success stories and then really committing to them, over-committing, not following a disciplined, diversified approach.
Yeah, okay. So where do you think there is value at the minute in the market?
Well, again, you know, I'm an advocate for equity markets, so a lot of places I would say right now, you know, just looking from a valuation perspective, there's lots of opportunity, and it really comes down to you know, people's appetite for risk. You know, it really does, and I'm not using that as a sort of a cop out to not answer the question, but it really does. There's opportunities in more defensive areas of the equity market still. There's certainly opportunities in the right areas of more growth, maybe tech-orientated investments. However, I do think it's important that you're very selective with that, because there's lots of investments within tech post-COVID that have maybe been overpriced and may struggle to recover. However, there's also lots of areas that are classified in that segment that have been sold off with those, and they're still great companies. So I definitely think in that growth tech space, if you're selective, if you do your homework and you understand what you're buying, there's some great opportunities to be had there.
Okay, so I'm bought into investing in the stock market. What's the best way to do it? How do I do it?
If you wanted to invest in the stock market, there's lots of different products you can use. Obviously, accessing it via an advisor who has access to different products that you perhaps maybe don't have on the retail side of things is probably a good approach as well. Investment platforms are always a good place to start.
Okay. And what mistakes do you find that most sort of DIY investors make, especially in times like now? Not being objective, letting emotion rule their investment decisions. You know, we see it all the time, and you know, look, in younger years, I'm sure we've both probably fallen foul to that ourselves as well. Because you know, we're all human at the end of the day. Looking at your own money is much more difficult to remove that emotion. I think if you give it to someone who's able to look at it objectively, or even, you know, if you're able to look at it objectively yourself, that's fantastic. But I think that's the biggest mistake people make is they let fear overtake their investment decisions. They let greed overtake their investment decision. When things are going well, people want to buy more of that. They like it. They like the feeling it gives them. When things are not going so well, they want to shy away. They don't want to take any more of that risk. They don't want to see any more losses. So they're not willing to stick to the plan that they put together. So yeah, I think letting that emotion dictate
is probably the biggest mistake that people trying to manage their own investments do. Likewise, in lots of different sectors and services that people could employ someone to do to try and do themselves.
Yeah. I agree. Right. Okay. Cool. Right. Well, Iain, thank you. When we finally got you on, thanks for your time. Where can people find you, or where can people find more information?
So, I mean, anyone who would like to can subscribe to our weekly investment podcast. It's the AHR Weekly Market Update. You can get that on Spotify, you get that on Apple as well. And then I'm on LinkedIn, Iain Ramsay on LinkedIn. I often share some of my thoughts, some of my insights from myself and the business on our investment approach. So yeah, feel free to reach out.
Perfect. Right, Iain, thanks for your time, buddy. Take care. And